All right, well, I'm excited to be back in the black hole of real estate, and I want to go over some numbers with you about a single family home report with the sales that related to the Daytona Beach area through the month of June. And the first thing that we notice is that when we look at this June sales, 461 in the Daytona Beach MLS reporting, with a median sales price of 377, and we turn ourselves to last year and say, what was going on at that time? And what we'd find is last year's 442 sales, so about 20 more this year in a market that people say is off or down. So there's more sales. Now, for the first time in a while, the median sales price compared year over year, see, last year was 385, this year 377.5, so 1 or 2% off. And I find that a little bit interesting. So the units are up, price off just a little bit. Now, if we look at just a month before that, in May of 23, 478 in sales, median sales price of 378, so it was about $500 off in the month of June, so pretty close. So the sales are remarkably consistent for May and June of this year, and a little better than last year. The median sales prices, I mean, considering the dramatic increase in interest rates and inflation, everything else with it, the price is largely held within 1%, possibly 1.5%, so it's super close. And it's further evidence that the market didn't crash. And it didn't do what so many people thought it would do. It was like, oh, 2008 all over again. See, it didn't happen. And the numbers continue to show that. Year-to-date sales, 2250 compared to 2530 last year, so about the same. Median sales price year-to-date, 373 and change. Last year, 372.5. So almost identical to last year, year-to-date, through the half-year reports. It tells me the market hasn't changed that much, despite all the changes to the global markets, and banking, and interest rates, and inflation, and economic pressures. The real estate market is largely the same. Now, we do have a difference that we can report back. The local area is bucking the trend of inventory levels going perhaps negative in year-over-year comparisons. In this market, June of last year was about 1,300 and change available inventory at some point during the month. This June, about 1,600, so pretty good increase. And even from May, there's about 50 more homes available in June than May. So one might suggest that the inventory is up, even if it might decrease a little bit over the next couple of months. It's up for the year. And if people were looking for more inventory, it's here. So the sales, largely the same. Median sales price, largely the same. And inventory up a little bit. And I'm not sure if that's good or bad. I think it was just numbers. But if we were expecting to be a little bit more inventory, it happened. If we were expecting prices and sales to be about the same, it happened. And if you're expecting something different, we don't have evidence that that's going to be a different story to report back in the next several months. Now, there is this insurance thing that just continues to help some of us scratch our heads without having to do it actually ourselves. Now, here's what I mean by that. We know that insurance is up, in some cases, as much as 30% across the board. And one would think that would affect sales and pricing, but I just gave you the numbers that said it isn't yet. Now, will it? I'm unsure. But my suspicion is that insurance rates are not just going to go up locally. National companies are going to apply those increases nationally. So if the insurance is more expensive in Florida, I'm going to suggest that it's going to be more expensive all over the country. And everybody will feel the insurance increase. So that may not drive one market over the other or cause one place to become more attractive than the other. And I can't think of the last time somebody moved because, well, I've really compared everything about these two homes and two cities and two states, but the insurance was a deal breaker. We chose this house in this state in this city because of the insurance costs. It's not in most people's top 5. Quite honestly, it's probably not in most people's top 10 as far as non-negotiables, things they have to have in a house. I don't think the insurance is the one that's going to tip it in the wrong direction. But if you're in a condo, and let's say for a moment you're asked to join the association board, or there's a board in place where there's an opening and you're just giving it some thought, maybe I'll get involved this time, or maybe a good place to meet some people or play some cards or just relax. Or maybe you want to keep the fees low. Well, here's the cautionary tale that's going on, and it's not actually cautionary, it's rather alarming. In order to keep fees down, there's only a couple things you can do. One, I guess you could add more units and spread it across more people, add another building. That's probably not happening in most condo developments. Or two, you can renegotiate some fees, which you might save a little if you bundle some services, but maybe not move the needle dramatically. Or you can look for cheaper alternative options. And one that's come up right now, a couple, is the insurance. There it is again. And let's suppose that the top of the line insurance for replacement costs in a building in a catastrophic situation, like a hurricane, damages to the point that it either has to be knocked down or completely renovated. Well, there's insurance out there that's available that is not replacement cost for the building. Now, the risk that gets carried with that is that if something tragic, catastrophic happens, there's no way to rebuild the building. So either the owners are all going to have to pool their assets to make up the shortfall from what the limited insurance policy might cover to rebuild the building. That would be pretty painful for most people to write a check that big to put the building up, and they would all have to do it, not just a couple, or they'd be underfunded. See, the alternative to something catastrophic is that, let's say there's 100 owners and there's 100 condos and they're worth $500,000 each. I'm not sure what the dirt is worth, but let's say it's worth $1 million or $2 million. I guess you have your 1/100th of the dirt because there's nothing else in a catastrophic damage. And whatever insurance you might receive, it might be just to finish knocking down the building and haul all the debris away. So it's not necessarily a good idea to underinsure or self-insure unless everybody involved understands the risks that happen. And we haven't even gotten to the engineering studies that will have to be done on all the condos to meet the code, for the tragedy that happened in the Miami condo. And now you're faced with trying to reduce the insurance and renegotiating. Insurance company comes out, and what if they find other things? Maybe you were just trying to lower the insurance and liability on the building, came out and found out, geez, you know what, you guys need balconies, you need resurfacing done, painting done, maybe the roof needs to be done. Negotiating insurance could cause the policy that you currently have to become invalid. And this has happened. When you have an insurance policy that's less than full replacement cost, most lenders are not going to want to approve loans in that building. And if buyers cannot finance to go into a building, it in essence becomes a cash-only building. That's going to limit your pool of buyers. And if you're selling in a building such as that, you're likely to have to take a little bit less money or just not sell. And neither one's good for property values within the building. So saving a little bit on the insurance, or even a lot, can have some unintended consequences. Now, I'm not sure that overall they can't, get the roofs done, repairs done, get better insurance down the road to save some money down the road, but how long do you want to self-insure and take that risk collectively? And I'm not sure that every board that's voting on these insurances has looked at it 10 steps down the road to see beyond the monthly savings of $100 to $200 a unit owner versus the risk involved that what if something really bad happens? Or what if somebody wants to buy in the building and use a mortgage but can't? You see, when the unit eventually sells for a lower price, that's going to set a benchmark. And if it's lower, that reframes the values by sales comparison approach in that building. So it could actually cost equity down the road. And we see it happening. And let's face it, who's anxious to buy a building in a building where it's underinsured, where you buy a $500,000 condo or a $200,000 condo, and if something bad happens, you're out your investment. You see, I don't see people running to that. So is it short-sighted? Perhaps. It appears that way. Now, I do understand a lot of buildings have been under special assessments, and not every unit owner can afford those assessments. And with the cost of insurance increasing, those monthly assessments, well, they're getting pricey for a lot of people. There's not an easy answer, but I know that cutting back on the insurance is not necessarily the right move to make for most of these condos. And if they do find themselves in a cash only building now where no one can finance in there, I don't know how lenders feel about that, but if it's underinsured and the condo is the collateral, could a lender call in the mortgages? I'm sure it's possible. I'm sure it involves some attorneys, but I'd say it's possible. No, maybe that's 100 steps down the road, but we started with just trying to save a little bit on insurance, and we quickly got all the way to loans being called back, and that would be systemic. That would be a problem. My suspicion is that an agency or a government or a lender or an insurance company or some room of people that are pretty smart are going to get together and get in front of this. At least I would hope so. You see all the changes in the market, inflation, interest rates didn't turn us back to 2008. But something systemic that would affect property values in a way that we're not looking at, like the insurance on the condo buildings and underinsurance. Well, that could start something in the wrong direction. So, good news is, I believe there's a solution will be had, and that brighter minds in the associations are going to hear messages like this, and they're going to give pause to saving $100 an owner per month by lowering the type of insurance premiums being paid with less coverage. And I think they'll get in front of it because, to me, there's just too much risk on the table to make those type of cuts. So there's market update for you. I hope that this information has got you thinking. And I look forward to catching with you next week on the Black Hole of Real Estate.